welcome back to my channel. In today's video, I'm focusing on providing information on how to start day trading as a beginner. So I've listed a total of 8 necessary and detailed steps to take that are useful to get your day trading journey started. So let's go ahead and dive into it. The first step is choosing a brokerage, aka a trading platform. Now y'all already know I prefer Thinkorswim, which is why I have the Analyze tab in the dashboard pulled up, but you don't have to choose TOS to start trading. However, I would recommend selecting a broker with low commissions, fast execution, and reliable customer service. So for example, like E-Trade and Fidelity, those are pretty good to meet these standards. You also want to evaluate the trading platform to ensure they offer advanced features under like the charts tab, analysis tools, and other factors you'll need. And an easy way to begin is to set up a demo account as like a simulation to practice trading without risking any real money. Now the second step is going to be understanding the fundamentals of day trading and how the option chain is structured. So y'all can see I have PayPal pulled up here and you'll see why in just a second. Now in regards to fundamentals, this is one of the most important steps in learning how to day trade because you want to be sure to study the financials of the market and of course the security that you're choosing to trade, and this can include stocks, options, futures, and this is necessary to determine your focus within your trading experience. Now, as an overview, you can see here they are going to list the actual share price on what the stock is going for. So in this case, PayPal is trading for $90. They also give you an option to click on the financials tab so you can kind of go into detail to kind of get more information. From here, you can also download certain features such as like understanding the Morning Star, LSEG, Schwab equity ratings, and then you can go down to look at the company profile. You can look and see what they have as far as the detailed description. And then you can also take a look at the numbers by annual or by quarterly. And this is going to show you everything from share values all the way down to financial ratios and valuation. And you can again take a look at the trends over the last 5 years, and it'll show you a breakdown of all the numbers. I find this to be especially useful because if you're new to stocks and investing, these are all numbers that may not make sense at first, but once you get more and more clear on what you're looking to do, you'll start to research companies and understand certain things like earnings per share, net profit margins. You'll also be able to take a look at like the total asset turnover, for example, and even understanding the dividend payout percentages and yields. And to even take it a step further, you may want to look at the book value ratio and then compare this across different sectors and different companies within the sector. So now that we have that understanding, I'm going to go ahead and scroll back up. Again, this will take time for you kind of to understand the fundamentals, but the more you research and the more you learn, it'll become easier and more simplistic to break down the numbers. But now I want to go ahead and break down the trade tab so we can take a look at the option chain. So I'm going to go ahead and click on trade. And now we're going to go ahead and see that we have, again, PayPal is pulled up, same thing defaulted, but you can see the option chain here. Now I want to spend some time talking about this because it's very important to understand, especially if you're a new trader. Now, as I've mentioned in previous videos, it's important to familiarize yourself with key day trading terms like liquidity, volatility, days to expiration, which is like the DTE. You'll see that number here in parentheses, and of course like margin requirements, while keeping in mind the cost of premiums. So to understand that day trading requires a solid grasp on risk involved, such as like the market fluctuations and the potential for significant financial loss. But that kind of goes without saying. So as is relevant to the option chain, I'm going to just go ahead and click on the drop down so I can show you guys a few examples of what I'm mentioning. So the first thing you'll notice is that there's going to be an option chain for the filter to be off if you wanted to have it. Then you're going to see the spread for single. You can also choose vertical. Of course, they have the back ratio, calendar, diagonal, straddle. This stuff is a little more advanced, and I'll go over some of these in future videos. And then from here, you're going to see this little drop-down menu here allows you to customize this particular column set. So once you click on it, you can scroll through and add anything that you would want to be displayed for your option chain. I'm going to go ahead and click on cancel just for now because I'll show you guys how to customize that in a future video. But one thing that I do want to mention is that you'll notice that certain assets have different premiums on the option chain. For example, if I were to pull up SPY, let me go ahead and do that. I'm going to pull up SPY so that y'all can see what I'm saying. So for example, I'm going to collapse this for December 13th. So now you'll see that there are option contracts to choose from for nearly every single trading day. While for example, if I were to pull up Tesla, you'll see that it is not an option for that. You'll see it's just for the weeklies. So for example, December 13th, the 20th, 27th, January 3rd, these are all going to be Fridays. But again, SPY is going to offer this for every single trading day for the most part. You'll see the 9th, 10th, 11th, 12th. All these are going to be different days. Some people will ask, well, why is that? Well, one, SPY is going to mimic the S&P 500, which is the index. So you'll see that it's going to be completely different because Tesla is just a regular company. Now, that's just one thing I wanted to mention because it is important to know when you're looking at the option chain. But I'm going to go ahead and pull back up PayPal because I feel like the contracts are super affordable and it's good information for you guys to have in terms of new traders and beginning your journey. So going back to it, I'm going to go ahead and drop this down to December 13th once again. And you'll see that I have the open interest, the volume, the delta, the gamma, the theta, the bid, and of course the ask is pulled up. And then you'll see the same thing on the side for puts. Now, the reason that these elements are important, I'm going to break them down. First, I'm going to start with open interest. So just to quickly give a definition, open interest essentially all it is just the total number of outstanding or active contracts that have not been settled or closed. So these are all active and open, hence the name. So because it indicates how many contracts are currently in the market, this represents the level of activity or participation in a specific asset. For instance, if a trader opens a new options position, buying or selling a contract either direction, you'll see that the open interest will increase by 1. But let's say you go ahead and sell that's when it'll decrease by 1. Now, high open interest often suggests that there's strong market interest and liquidity in that particular contract, making it easier to enter or exit positions based upon the information you know. Now, conversely, low open interest, it may indicate less activity or reduced liquidity, which also could mean that you stand to make a little less money if you're not trading in the proper aspect. But again, it all just depends on various different factors. So now that we understand open interest, I'm going to move on to volume. Now, just to give a quick definition of volume, this essentially just refers to the total number of shares or contracts. So to put it plain and simple, it's traded for a specific security or market within a given time period, such as like the day. So in the context of options or futures, it just reflects how many contracts have been bought or sold during that period. So unlike open interest, volume measures active contracts. It tracks all trades, including both opening and closing transactions, which is why high volume often indicates strong market interest or momentum, while low volume may signal reduced participation or indecision. And traders use volume to confirm the price trends. For instance, a rising price accompanied by high volume is often seen as a stronger move than one with low volume. So moving on, you'll see the Greeks pulled up, the delta, gamma, and theta. Now, I've made a previous video discussing these, so I won't go into heavy detail in this one, but the delta is going to show you what you stand to make per contract if you were to have the trade go in your favor by a $1 incremental move. So for example, if you're placing a call for PayPal at the $91 strike here, you're going to see that the delta is at a 0.39, which means you make $39 if PayPal were to reach $91. So it would have to move up $1 move in order for you to actually receive the delta amount. You add the gamma as well in terms of making sure it incrementally moves up by that dollar. And then the theta is going to be something that's relevant only if you're swing trading. And the theta essentially just tells you what you stand to lose per day if you hold the contract overnight. So in this case, with the $91 strike, you would lose $18 if you were hold this contract for a 24-hour period. Moving on to the bid and the ask, this is going to be the price of the actual premium. So for example, the ask is going for $88, and then of course the bid, it'll be $82. Now with this, it's totally up to you. I know some people choose to buy the bid and some people sell the ask. Some people only buy the ask and they sell the bid. That's really a choice that you would have to make based upon your own preference. All right, so the next thing I want to discuss is number 3 on the list, which is going to be setting realistic goals and expectations. Now you want to determine your financial expectations beforehand and what you aim to achieve throughout the day, the week, the month, and then of course the year. So this could be your daily income, it could be portfolio growth, whatever specific targets you have, you want to make sure you make those very clear before you start. Now keep in mind that consistent profitability requires months or even years of practice, so your initial focus should be on skill building rather than fast profits. With this approach, it'll help you avoid impulsive or emotion-driven decisions. Now with this in mind, it leads into number 4, which is going to be understanding technical analysis and of course how to read the charts. So I'm going to go ahead and hit the charts tab so we can discuss this in more detail as well. So, a crucial part of day trading is learning technical analysis, as mentioned. So, within that, it's absolutely imperative to study candlestick patterns, support and resistance levels, moving averages, and volume indicators so that you can better develop an understanding of price action. And this allows you to identify trends, breakouts, and even reversals. So, some really good tools that you can use if you're just starting off are going to be like the RSI, the MACD, even the Fib retracements, which is Fibonacci's, and this will help assess potential trade setups for you. So in order to do this, to pull up the studies, I like to call it the beaker icon, but it's really the studies icon. You just click on this and you can go ahead and see where it says edit studies and strategies. So you can add different studies here, different strategies here, or even different sets. Now there are so many to choose from, so it will take you a while to kind of understand all of these. I don't recommend adding a ton of different indicators on your chart at one time because it can be very clouded and it can also change your judgment on what you think you know as far as your trades. So I would say take it easy and kind of be simplistic to start. And then once you're comfortable with understanding a few of the indicators, then move forward with that. Now, if you are seeking to look at like the Fibonacci's, for example, it's not going to be under the studies. It's actually going to be under drawing. Some people kind of get this confused. You would need to go to drawing tools in order to find the fibs and then go all the way down till you see this percentage. This is the most commonly used Fibonacci retracement. And again, I'll make a future video kind of discussing this in more detail. But if you were looking for it and you couldn't find it under the studies, it's here under drawings. Now, with that being said, it is important to practice interpreting charts in real time, as this is essential for making quick decisions in the market to improve trading evaluation speed. Now, this doesn't mean rush into trades, but it does mean that when you're trading higher volatility stocks or ETFs, you'll be better able to enter and exit positions without fail. So be sure to stick to your price targets no matter the direction of the stock, because that way you're minimizing the risk and also maximizing the potential gain. That leads into the fifth step, which is developing a trading strategy. So you want to choose a trading style that suits you, such as like trend trading or momentum trading. You may even trade like breakouts or reversals, and you can use any of these under the scope of day or swing trading. Because what's most important is that your trading ideology should be clear and detailed for the criteria, outlining your risk management rules and your take profit targets. A good thing to know is that when trading options, you want to consider strategies that account for the cost of the premiums and factors like the Greeks, specifically, of course, as I mentioned, the delta and the theta. And before trading live, test your strategy through backtesting with historical data in a simulated environment. Now, one of the most commonly asked questions is how do you know to chart for price levels and how do you define specific areas that are going to be necessary in terms of understanding how do I draw trend lines? Now, the reason I say it's important to understand the charts before you participate in any of this is that you want to understand the function of them before you even start so that you're not just putting pointless lines and shapes on your chart without understanding how they function. So, let me break it down in the simplistic way. When you look for price levels, you're also looking for support and resistance levels at the same time. And the easiest way to do this is one, look for gap fills, and then two, look for where certain candles have met a specific zone or area multiple times. So for example, if you can see touches 2, 3, or 4 times in the same range or same zone, that's typically going to be either area for support and resistance. Now, because we know that history repeats itself over and over, the stock market makes it pretty easy to be able to chart for these kind of things. All you would have to do is just go through and look for specific areas and levels where you see the stock kind of touching on certain price levels multiple times over. And once you see those levels, you can literally just chart for them. Now, it sounds easier said than done, but again, it's one of those things where you just have to understand what areas are going to have those breaks and retests, what areas are going to respect or reject the support and resistance levels, and then of course what areas are going to provide the most consistent level of momentum based upon what you've seen historically on the charts. Alright, so next on the list is going to be number 6, which is going to be mastering risk management, and this will take time. So with that in mind, you want to be prepared to have realistic risk management strategies. This includes setting a daily or weekly loss limit to protect your capital. So many traders use a risk to reward ratio for each trade. So for example, if you're risking $50 to gain 150, this ratio represents a 1 to 3 risk to reward ratio, or 3R, which is some people call it. Now this means for every dollar you risk, you aim to earn $3. This type of ratio is often used in trading strategies to ensure that the potential profits significantly outweigh potential losses, even if you don't win every trade. For example, if you're just starting off and you win 60 to maybe 70% of your trades, which isn't really a good percentage, but hey, if you're just starting off, you're still learning. But yeah, if you're winning that yield of your trades, even with this ratio, you can still be highly profitable over time because you'll likely refine your strategies and get better and better. So you always want to be sure to limit the amount of capital you allocate to any single trade to prevent overexposure, and always trade with a stop loss or trailing stop to minimize potential losses. All right, so number 7 on the list is going to be practicing discipline and emotional control. So within this, it's important to understand that you want to keep your emotions like fear, greed, and frustration in check by sticking to your style of trading so that these emotions don't influence your decisions. And you have to accept that losses are a part of the process and avoid chasing the market to recover quickly. So, more true than anything, consistency is key. So, avoid changing your strategy impulsively after just a few trades, even if they don't win, because altering your approach too soon can be detrimental if you're making spur of the moment moves. And then finally, the last step is to commit to continuous learning. There's really never a such thing as learning enough, especially when it comes to trading. Now, I don't think that you should implement every single thing you learn because that can be foolish, but it's worth at least knowing the information because most concepts in trading can be applied in different situations. So, you want to make sure you review your trades daily to identify and document what worked and what didn't. Ideally, you want to stay updated on market news like the economic reports and even earnings announcements, which all can and will impact the market, thus potentially impacting your trades. So, really, all in all, by following these steps, remaining patient, of course, and integrating advanced concepts as you learn, you can develop the expertise needed to trade effectively and succeed as a day trader. So, don't make it harder than it has to be. So I know this video was kind of quick. I was trying not to make it too long and I didn't want to provide too much detail to confuse anyone. But with that, that'll pretty much do it for this video. If you did find value in it, feel free to leave a comment down below. I thank you so much for watching and I'll see y'all in my next one.